Welcome, ladies and gentlemen, to realestateinvestormba.com. At Real Estate Investor MBA, we strive to provide valuable information from various experts within the business and real estate community, covering real-time market and economic information as well as curriculum-level material within various real estate investing niches. We aim to be relevant, straightforward, and forthcoming with actionable information for our community. And here's your hosts, Tejas Gosai and Jeremy Moyer. Welcome to Lehigh Valley Private Equity Fund. Lehigh Valley Private Equity Fund is a Regulation D evergreen private fund designed to provide a 7% preferred return and an overall annualized target return of 12% through diversification in lending and acquisitions in the real estate industry. With over 100 years of combined real estate, investment, and management experience, our management team is actively sourcing opportunities and improving real estate in the Lehigh Valley and surrounding regions. The Lehigh Valley is booming. The private sector GDP is larger than 112 countries, standing at over $41.2 billion annually. Lehigh Valley Private Equity Fund uses three methods to create returns for our investors: qualified lending, buy and holds, and rehab resell projects. Our philosophy is simple: quality over quantity. Our primary goal is to protect our investors, and our strategy is to produce consistent high-yield returns. Thank you so much for visiting us. Contact us easily by visiting www.lvpefund.com or call us anytime 24/7 at 484-362-1313. Thank you so much and have a beautiful day. Hello, ladies and gentlemen. Welcome back to your favorite real estate podcast. This is Real Estate Investor MBA, and we want you to check out our website, realestateinvestormba.com. We have about 15, 16 interviews so far, right, Jeremy?
Yeah.
And it's been a great initiative that we took place in. We tried to create this, and because of you and everyone that has been watching, listening, following, we're on iTunes, Spotify, iHeartRadio, Google Play, and a bunch of other places. We transcribe the podcast and make it available as well. And we got to thank our sponsors, the Lehigh Valley Private Equity Fund. And with that, Jeremy is the brains behind the operation and brings on the best guests. So thank you, Jeremy. I'll hand it over to you. Cheers.
Awesome. Thanks, Tejas. So I'm excited to announce our guest today. We have Jack Krupey. So Jack is a seasoned real estate and distressed debt investor. He spent the last 10 years focusing on residential non-performing mortgage market and was the founder of a firm called PRP Advisors that merged with a large private equity fund and completed more than $3 billion in whole loan purchases to date. Currently, Jack's with JKAM Investments, and they participate with a select group of highly experienced real estate partnerships in the multifamily, self-storage, mobile home, and private lending industries. Clients and investors have the potential to invest in individual deals, as well as participate in the JKAM Diversified Asset Fund, which makes placements into many diverse projects. JKAM is actively participating in hard-to-find off-market opportunities, targeting strong risk-adjusted returns. They provide investors access to deals with larger minimum investments that are exclusive, typically to institutional partners. These alternative assets are opportunities for investors to earn passive tax-advantaged returns, which are not correlated to the stock market. So, Jack, thank you so much for your time this afternoon and joining us for an interview.
My pleasure. Thanks for having me, and sorry for such a long bio, but I appreciate that. Appreciate it.
Let's start off with Jack, just telling the listeners a little bit more about yourself. How did you get into the distressed debt space, and then why position yourself in the real estate the marketplace?
Sure. So I've been in real estate since 2001. Shortly after college, I'd started buying some rental properties in Rochester, New York, where I went to school. But I'm from from New Jersey, and grew up in the kind of the suburbs of New York City. So cut my teeth in the sort of traditional real estate, wholesaling, fix and flip, rental properties pre 2008. And then after the 2008 crash, was moving back closer to home in New York, and found a job at a small private equity fund that was buying non-performing residential mortgages. So this was November 2008, so the bleeding edge of the financial crisis, and this fund needed people with real estate experience. So they were buying thousands of non-performing second mortgages, home equity lines of credit that were in default, and they were paying 3 cents on the dollar. So that was again, it was 2008. Nobody would have expected the recovery and the level of modifications and just the way the market had adapted over the next couple of years. So that's where I got my initial exposure to non-performing loans. I was there about a year and a half, then left and started my own small fund. Ended up partnering with one small family office, just with a few $1 million of capital to start building a track record of buying non-performing loans from other funds. And we were planning on doing a private placement and raising a more official fund in 2014. But then we linked up with another private equity fund that wanted to move into the non-performing loan space. They'd historically bought credit card debt and other receivables, but not mortgages. And we did a $5 million test fund with them that turned into 10 million, that turned into 50, 100. We merged with them in 2015, and over the next 5 years, bought close to $3 billion in purchases, over 30,000 loans, including from Fannie Mae. We transacted with Goldman, all the major street players. We were buying large portfolios from them. And it was a great business, but it was very institutionalized at that point. And I'm an entrepreneurial guy, and eventually decided to leave and start my own fund. During this time, I was also doing investing as a limited partner in various real estate syndications. And what I saw was, I knew a guy from Long Island that bought apartment buildings in Charleston, South Carolina. I knew one other guy who was in the Columbus, Ohio market. And, I had to, kind of choose which projects, who I was going to work with and sort of, where I was concentrating my risk. And, I was looking around for a more diverse option. And other than buying REITs or just more traditional off-the-shelf financial products, I didn't see a more diversified opportunity to take advantage of the syndication market. So that's part of the reason I chose to launch this fund, which actually takes multiple positions with multiple operators in multiple markets. So I've said a lot right there.
Yeah, it's awesome. Jeremy, did you have a follow-up?
Yeah, I wanted to follow up just to give the listeners a more thorough explanation and picture of the value add that your fund does bring to the market, Jack. I think it's an interesting story. You touched upon it just a little bit right there. Do you mind kind of going a little deeper?
Sure, yeah, absolutely. So, it's somewhat of a fund of funds model, but I'd say fund of syndications. We partner with experienced operators that either have their own private placement or in some cases just a direct joint venture, to co-invest with them into apartment buildings, self-storage. We're looking at a senior living facility. But a core asset for us is Class B multifamily value add, generally buildings that are between 100 and 300 units, which are large enough to have a full-time management team, on-site management, but not so large that you're competing with institutional investors. And what I found is even very experienced, successful operators, when they find a building, they have 45 days to raise, in some cases, $3 to $5 million. So even operators with a really good network, a good investor base, are always looking for larger checks. And our fund, one of the ways that we provide better terms to our clients is we'll actually get better terms from the sponsors, either a higher preferred return or a discount on their management fee. In some cases, we actually become a co-sponsor and get a percentage of their general partnership, which actually increases the fund's returns. So in many scenarios, if someone were to put 50,000 into my fund, they'll actually get better deals than if they put 50,000 directly into another fund. And the diversity is key as well. So I talked about my own issues of having to choose between, do I invest in Jacksonville? Do I invest in Charleston? And so far, we just launched in September, and we're already in 3 different buildings. We're in a 104 unit in Augusta, Georgia. We're in a 286 unit in Phoenix, Arizona, and a 260 something unit in Jacksonville, Florida. So 3 markets that I like for different reasons, with 3 different operators, each of which I've known for a number of years. 2 of them I've had other money with in other projects. So I feel like we're off to a pretty good start for building an asset base. And my expectation is about half the fund will be these types of apartment buildings. And then we'll strategically make some other investments in either private lending, ground up construction, self-storage. If we can find, as deals cross our desk that make sense, we'll continue to allocate the fund.
It's awesome. A question from my side: what exact kind of fund is it, if you don't mind sharing? Because I know there's different classifications, things like that. Is it a regulation D, A? If you don't mind explaining.
Oh, absolutely, yeah. So we registered as a Reg D 506C, which is open to accredited investors only, but it does allow us to do some level of advertising. The recent law changes, the 506B, you can't really advertise. It's really supposed to be for your network you already know. So I think the C is really the safest way to go. But it does require us to formally verify that any investor we take it as accredited. We use a third-party company called Verify Investor, so we don't need to see our clients' tax returns, but they can just upload either a CPA letter or just upload some information, and a team of attorneys will provide us a verification letter that the investor is verified.
Nice.
And we also use a platform called Syndication Pro. So we have a portal that investors can log into. It has all the documents, the PPM, the fund terms, and the quarterly reports will be up there, and it makes it pretty seamless process. We chose to also use a third-party fund administrator, a group called Strategic Fund Services. So they actually administer all the quarterly accounting, provide reports, track the investors' basis on their the capital the capital that's been returned, their preferred returns, and really just provide all the third-party verification where so we could focus on basically communicating our message to investors and vetting deals and finding new opportunities.
Awesome.
I should also talk on the structure too, if you'd like to hear that, because we have a couple different share classes and a couple of different options.
Yeah.
Yeah. So we actually have 4 different share classes, and 2 of them are a fixed return, and 2 of them are an equity participation return, and they're both similar structure, other than for investors who put in a little bit larger amount of capital can get the higher return. So we have a 10% fixed return with a 3-year lockup, and we have a 12%, which it's actually a shorter lockup because it's really we're not always taking 12% money. We actually do that mostly as sort of a bridge so that we can, if we have a good opportunity. I have a few investor partners that are willing to come in short term on the 12% money, which eventually then gets replaced by the equity capital. So one of the big risks with a fund is having cash drag. If you raise all your money and you can't deploy it fast enough, it's just going to hurt overall returns. So that's allowed us to do really well with managing getting cash in and then actually deploying it into deals right away so that there's no cash drag. And then on the equity side, we do a 70-30 split. So the investors get 70%. We take 30% only after investors have received all of their money back, and then either a 6 or an 8% preferred return. And then we pay quarterly dividends. By nature of some of these projects, the first year The dividends, the quarterly distributions may accrue because by nature of doing value add, the first year, a lot of your cash flow is going to improving units. Generally, we're spending between $3,000 and $7,000 per apartment for the Class B value add to renovate. And when you have a building that's bought at a 6 or 7% cap rate, adding $1,000 a month rent over the course of a year increases the value by, in some cases, $60,000. So it's very key to our strategy to execute the value add plan. And given where we are in the economy, we think it's a very defensive investment. I'd rather be in Class B than Class A right now because there's really not much room for rents to drop much more. And people from Class A buildings or houses may downsize into apartments to save money. And in good economies, people may move up from Class C or just move out of their parents' house into an apartment. So I feel like it's a very defensive asset class given where we are.
Yeah, thanks for that. Also, super detailed. Thank you for explaining it that well. But going back to the Verify Investor piece of it, I don't know if everyone knows what an accredited investor is, but if you wanted to share that, just so, we can move on. I think Jeremy has something.
Sure. So actually the SEC just updated some guidelines recently, but the two more common historical tests were either an investor a single person who makes at least $200,000 a year for the last 2 years, or if you're married, a combined income of $300,000, or a $1 million net worth, excluding your primary residence. But it does include retirement accounts as well, and that's something I know a lot of investors have done. Is they actually can self-direct a retirement account through one of the various custodians. There's some of the new rules have to do with if you have professional certifications. There's some other exemptions in addition to that I just don't want to misspeak. But by the time this comes out, you could probably post it in the show notes on the link to the SEC article.
Awesome, thanks for that.
Thanks, Jack. So I have a question that might have to give some thought. So a lot of us, look at numbers all day long. There's so much focus on like the technical underwriting of deals, terminology like cap rate, IRR are very commonly used. I do think it'd be important to also hear like the actual thought process that is coupled with the technical underwriting, from an experienced fund manager like yourself, Jack. So when evaluating a specific investment, what are some of the more important attributes and parameters that you're looking for? And then can you also walk us through an example of one of those assets that the fund invested in and what was attractive to participate in that particular venture?
Sure. So, we as a fund of funds, if you will, I mean, it's very important that we have operators that we have a level of trust and experience with, that we trust can execute, especially if there is a challenging in time. We were 10 years into an upcycle, and we had obviously a lot of uncertainty now between COVID and the election. So it's definitely the operator. The markets, we're tending to be in the Southeast, Texas, and then the Midwest. We like Arizona, we like Denver, we like Boise. Markets where people are moving anyway. Even pre-COVID, people were leaving California for these markets. People were leaving the Northeast for the Southeast. So we are trying to follow some of the trends. We're not baking in guaranteed appreciation from just economic cycles. We prefer to just bake in the forced appreciation, but at the same time, I do like the upside of being in a diverse set of growth markets. An example of the deals that we've done that we're in so far. I mean, the Augusta, Georgia deal is very, very interesting. Just we're actually our partners in at $77,000 a unit, and there's comparable sales of larger buildings for $130,000 a unit. And this is a value add. So this building on its own, we might get above $100,000 per unit after the renovation. But one of the strategic things in these markets is, can you actually aggregate a few buildings together? And this operator is looking for other deals in that market. And 3 to 5 years from now, part of the exit strategy could be, if they're successful in buying another building in that market, it's going to increase the sale price for both of them, because we may be able to exit to a larger fund, or even a REIT that we can aggregate 500 units to, that wouldn't look at it if it was only 104 unit. So that's definitely the art and the science and the relationship to underwriting these deals, as opposed to just the financial models.
That makes sense. So, and you talked about the price per unit. Do you also look at the price per square foot in multifamily? What has a higher weight per se?
It really is a combination. I don't know that there's one weight. I think it's really looking at the comps.
Sure.
Do the comps make sense? Luckily the operators we're working with are all very experienced and put together pretty detailed financial packages. With comparables, with exactly the unit mix, the price per square foot, what other complexes are at currently, if the other complexes have already been renovated with the value add, or if they're still kind of the same vintage. So it's really an all of the above. And one of the sponsors we were on the phone with yesterday, are you leading the market, or are you sort of I think they use the terminology, are you an explorer or a settler? And they like to be in deals where someone else has already maybe pushed the higher end of the market, where a 2-bedroom, 2-bath is renting for $1,350, and they have rents at $1,100, and they're targeting $1,250. They're not even targeting the highest end of the market. So those are all good signs that you're not pushing the highest end of the market for rents.
That makes a lot of sense. So, Jack, on the capital raise side, you're still actively raising capital for the fund, correct?
Yes, and we just our PPM just finished in September, so we really just opened the doors last month.
What are those conversations look like right now? I mean, given the current economic environment we're in, still potential uncertainty with COVID, I'm sure that having the diversity of spreading the risk across several different investment classes, different markets, helps sell the story. But what feedback are you hearing from investors?
Let me jump in too to add, how is the presidential election affecting you and the timeline over the next 6 months?
Sure. I mean, there's definitely been some uncertainty about the election and affecting decisions to invest. There's also fear of what happens in the capital. What happens if there's talk of raising the capital gains rate or eliminating capital gains. I feel like that comes up every 4 to 8 years. I could see. I mean, they raised it a few percent during the Obama administration. I just think there's enough rich Democrats and lobbyists as well that I can't imagine that it just goes away. I mean. Investors are a lot of questions we get are, what happens when the PPP and the government stimulus runs out? Are tenants going to just stop paying? And so we go through a lot of the statistics. Fortunately, I've been in some deals personally before the fund, and then the operators that our fund is invested with also, most have thousands of other units. So we've got a lot of data. So I've been sharing the data that we've aggregated, not just in the 3 deals that we've went into in the first month of our fund, but the portfolio wide. And a majority of the operators, especially on Class B, are collecting within 1 or 2% of the rent they collected last year. By nature, the workforce housing, the type of clientele are the warehouse workers, the Amazon workers, the drivers, the people that haven't been as affected by the crisis. Jacksonville had the highest net migration of population since COVID. So it's an area people are moving to. People are moving out of the Northeast, moving down, and it's accelerated it. So people are concerned about the election and just overall, is the bottom going to fall out of the economy? I'm very bullish on residential. There's still not enough housing supply. And, even if there is a wave of defaults and evictions, I think post 2008 banks are trained to modify loans if at all possible. And if someone was affected by COVID, lost their job for 6 months, now has a new job, they're gonna they're going to be able to get modifications, and that process was established. The processes weren't very smooth in 2008, 2009, and a lot of new processes, a lot of new regulation came on board. Some of it was helpful, some of it, like HAMP, probably, in some cases maybe, wasn't our favorite program when we had to administer it. But I think overall the point is that the residential sector I feel pretty bullish on, especially in the class B workforce housing sector, commercial, office, retail, restaurants. There's going to be a lot of distress, and it's not something we're going to back the truck up into. But I do think there could be some interesting opportunities to buy distressed loans at 50 cents on the dollar, and we'll be keeping an eye on operators that focus on those asset classes. Some office buildings might be in really good locations where it's cheaper, where it makes sense to knock it down and build apartments or houses, because there's still a nationwide housing shortage. So those are the key. It's really economy driven. People worried about the election. People worried about how long COVID is going to impact the economy.
When you were saying there's that many people, were you saying flocking to Jacksonville?
We grabbed it from just an article online that listed the top 10 cities for net positive migration since COVID. And Jacksonville was number one. I think Phoenix was also on there. Two of the three markets we were in. So I can grab the actual list and then send it over to you guys as well.
I'm also, I wanted to mention something funny, because that's obviously a good list. I have some investors who are like, where are they all flocking out of so that we can hammer it next year and pick up, as much as we can. So it's really neat how, honestly, everybody had to reinvent themselves to some degree. And now it's like, what's good data and what's not. And, it's funny because it's not just in the media and this and that. It's also in the real estate world. It's incredibly shifting, changing, and you got to stay ahead of it. So it's cool because, you really have a good pulse on it. And it's good to hear some of those other markets. Are there other places that you're looking to, specifically move into that you've been researching?
It tends to be the Southeast, the Southeast, the lower Midwest, Texas, Phoenix. So it's not that there's one exact market we love, but we do follow the operators that we're very comfortable with. So, most of the operators, the group that did the Augusta, Georgia deal, also bid on a deal in Cincinnati. So we would have participated in that deal had they won, but they were, I think, a few $100,000 off on pricing, and they weren't going to stretch. We tend to, one of the impacts of COVID is, these secondary markets or tertiary markets. I'm not saying that office culture is dead, but I do think 3 to 5 years from now, maybe 10%, even if 10 or 15% more people are able to work remotely long term, that's going to be more opportunity for people that want to co-locate in secondary markets. So a market like Augusta, as opposed to Atlanta, has a 1.5 higher cap rate, and that makes a big difference. That puts us in the deal at above a 10% cash on cash from the start. So even if there is a bit of a downturn, or even if the economy slows down or interest rates go up and it's harder to sell at an attractive cap rate, we're holding at a very solid return. So we don't want to go somewhere so rural that that there's maybe not a market, but I do like the secondary markets. I'd rather take a point higher cap rate in an Augusta or a Jacksonville than stretch for Metro Atlanta or Texas. Right. Texas is very competitive, and there's a fair amount of groups that are Texas only that will pay a premium for Texas assets, and you have property taxes are potentially higher if you're not set up right to fight your tax assessment. So, but yeah, with that said, there's not a market we wouldn't do if the deal makes sense.
Totally.
That makes a lot of sense, Jack. So from it seems the business plan is to find those top level operators and link up with them and evaluate their business plan, their deals that they're invested in. What kind of, and you touched base on it really briefly when I asked you a question earlier in the interview, but what type of due diligence do you do on operators if you haven't invested with them before? You're just meeting them, recently or whatnot. Like, what do you look for?
Sure. Yeah, we look for the level of experience and track record that they have. We don't want it to be everybody's first project. I know so a lot of times teams come together where usually someone's got a lot of experience, and usually someone needs to have deep pockets to be able to sign on a multi-million-dollar loan. So we do diligence the management team at a high level. We want to look at the projects. Because we see so many, we're also able to compare the numbers and the rent, where they're targeting the rents, where the rent comps are. We have some good relationships with some of the major lenders and desks as well. I've got actually a friend from business school that's from Kellogg that works in Chicago at the Marcus and Millichap debt and equity placement desk. So if I need to double check something, I've got good friends that can double check some numbers and say, hey, are these rent assumptions reasonable? Are there any other comps? Do you agree with this assessment? And it's not like there's a 100-point checklist, but it's the basics on do we trust they underwrote the deal properly? Do we trust they have the ability to execute? Is their property manager, are they trying to manage themselves, or are they using one of the best property managers in the area? Our deal in Jacksonville, I actually knew the sponsor for 10 years because he'd also been involved in the single family REO to rental market. They had flipped hundreds of houses to Cerberus. So, they're only on their second multifamily building themselves, but I knew them through other courses of business, and their property manager actually is co-invested in a deal with them. So wow. This multifamily deal came to them from the property manager who has their own skin in the game, and they, manage thousands of doors. So, we feel pretty comfortable with that deal. So sorry if it's a slightly vague answer. I mean, there's no one size fits all answer.
I think you're being super clear, and I mean it's great information. I don't think we've had somebody as robust as this on this side of the spectrum. So it's great. I am going to give us a warning though. Our producer gets mad after 35 minutes. Yeah. But Jeremy, maybe one more and then we can wrap it up.
Absolutely. So I started to ask this question. I think it's a fun question to ask. So Jack, what's your superpower that you would say that you have as an investor? What are you top level at that you just bring to the partnerships that you're involved in? I'm a natural connector,
across all the business lines I've been in. And I'm also pretty recognizable. So when I go to conferences, I seem to, I'm memorable for better or for worse when you look like this. But in all seriousness, I've been, I've always been relationship driven. I have sort of this idiot savant memory of what people do and how to connect and reconnect people. So, I'm always trying to figure out how there's a win-win and where I can connect people. And I will remember weird things about what people do. And when I think I've got this natural curiosity and sort of natural, optimism of how to make some deals happen. So, I think that really has paid dividends for me over the years, and just making contacts, and then people think of me when they have something they think that I might be able to be to take advantage of. So, and it's fun for me. It doesn't feel like work, and that's part of this business for me at this point too, is structuring it in a way where I enjoying what I do. I've always been an evangelist too. I was the guy telling people to buy rental properties when I was 22 years old, buy a 2-family house, rent the other half. Yeah. I was early to non-performing notes, telling people to buy notes. I've been just more on a personal level. I'm into points and miles. When you could fly and travel the world pre-COVID, I was the guy who was use your Amex card for this, get miles, fly first class for free. So I enjoy kind of giving information out, and it's a natural progression to do that on more of a wealth management play at this point, because a lot of my colleagues and cohort are getting to a stage where we're actually starting to make reasonable money and pay a lot of unreasonable taxes. So I find myself talking to a lot of investors about depreciation now, and even some guys I work with that, were in the non-performing mortgage space, on Wall Street, weren't really as familiar with, why a private investment like this would be a much better deal than than buying a REIT. That, a REIT does not even have a qualified dividend because the REITs aren't taxed first. So you're actually paying a higher rate of tax on a REIT distribution. Whereas these deals, you're generally showing a loss on your taxes, even though you're getting a positive preferred return and return of capital. So most good syndication deals, you don't pay tax until the building sells, and then it's capital gains. And one of the new deals we're looking at, they did a cost segregation study. So on a $100,000 fund investment in that deal, we're going to likely have a $50,000 tax loss the first year, even though we're going to make likely an 8 to 10% cash on cash return that same time. So
bravo.
I really enjoy sort of just strategizing. It's like I'm not a licensed wealth manager by any means, and I don't touch stocks and bonds, but I enjoy kind of helping work with investors to learn their situation and how we can help them be efficient. And then on the sponsor side, it's love to make deals happen. When somebody has a deal and they're looking to raise X number of millions of dollars to make the project a success, it's just fun to be part of that team. Real estate is a team sport.
Yeah, definitely the chase. Awesome. So that's Jack Krupey, and we're sharing his website information. We kind of pulled it up earlier for a second. But great information, and I think we'll have to have you back maybe end of first quarter or something next year, kind of touch on your projects, what you've been doing, where you ended up. But appreciate it very much, Jack.
Absolutely. Thanks so much for having me, and really look forward to doing it again.
Definitely. This is Real Estate Investor MBA. Check us out, realestateinvestormba.com. We'll have this episode transcribed very shortly, and it'll be online as well with subtitles. And don't forget to check us out on iTunes, Spotify, iHeartRadio, and a bunch of other places that Jeremy has masterminded. Thank you, Tejas over here. That's Jeremy over there, and we'll see you next time.